People save and invest for a number of reasons that change over their lifetime. Regardless of the reason, the focus should always be on reaching your financial goals with as little risk to your portfolio as possible. Retail investors have been told the traditional formula for good long-term investment results is a balance between stocks and bonds. The challenge here is that most publicly traded stocks and bonds, regardless of diversification, are tied to the global markets and rise and fall together. This traditional allocation has had poor investment performance and has been quite volatile, causing investors to panic and bail out of their investments at the wrong time. Worse yet, they don't end up participating in the recoveries that follow, making their returns even poorer. After years of gains and losses, your investments may be worth no more than when you started. There is an established investment strategy used by successful billion-dollar pension funds and ultra-high net worth families, one that provides more consistent returns and limits volatility. This strategy favors extensive diversification and cash flow. Bonds and equities are still used, but that conventional formula accounts for less than half of the asset allocation. These portfolios offer broad diversification across many different asset classes that are less reliant on a volatile stock market and focus more on stable and predictable cash flow. Cash-flowing investments can provide a steady income despite market fluctuations. This allows investors to keep their money constantly working, providing revenues that can be reinvested. In fact, if in 1950 you invested $10,000 in the S&P 500, your portfolio would have been about $750,000 by the end of 2011 based on price appreciation. But if you reinvested the dividends, all the cash flow, your portfolio would be worth $6.3 million, over 8 times more. Cash flow also provides stability. Here's one way to look at it. When you own a rental real estate property, you tend to focus on the monthly rent that you receive as income, or cash flow. You're less concerned with the annual price assessment of the land and building as long as the rent is met every month. So why is it different for your other investments? If your investments are paying you good, consistent cash flow, there's less need to focus on fluctuating price. How important are diversification and cash flow? Let's say you need to earn 6% each year to reach your financial goals. If 4% can come from cash flow, which is more stable and predictable, then you only need 2% from less predictable capital gains. This investment philosophy helps you meet your objectives while being less reliant on volatile publicly traded markets. Investors with a diversified asset allocation and a focus on cash flow experienced a far less volatile ride through the worst equity markets in a generation and are in position to weather storms and safely reach their goals. With peace of mind like that, reaching your financial goals can be much smoother sailing.